What's up, everybody? Welcome back to the number one real estate investing show in the entire world. I'm Jason Balin from Hard Money Bankers, and this is Ian Horowitz from Equity Warehouse. What's up, Ian?
What's up, brother? We haven't done one of these in a while. This has been good.
We usually do in-person podcasts. As soon as we built the studio, we tried to do a lot of in-person ones, but the problem with in-person is it leaves out a lot of very, very good guests and a lot of very good entrepreneurs from all areas of the country. And that's what we have on today, isn't that, Ian?
Yes, yeah. We are bringing in Dan, who I recently met through an online summit, coincidentally enough, where we both spoke about self-storage, all in our different asset classes. But before we bring Dan on, guys, hey, if you guys get any value out of today's episode, or you took away one nugget, or there's something that you want other people to hear, the best compliment you can give us, forget all the reviews, forget everything else, just share this episode, whether you're watching it on Facebook, YouTube, LinkedIn, wherever it may be. Feel free to share it so other people and other investors can get the same value, because we are in a crazy changing market now, and I feel as though information is the most important thing that we can give back right now at this time. So with that being said, Jay, if you want to bring in Dan from Rocket Dollar, and we will introduce him. He's all the way down in Austin, Texas, where we've podcast, we're discussing the home of Tito's. So
I'm doing great, guys. How you doing today?
Good. I guess it's maybe just a touch cooler than it is probably down there in Texas. What is it? Probably about 100 degrees down there today.
I think we're at 99, so I'm probably wearing long sleeves and long pants below this. And I've warm tea right now. It's really it's that cold here when it's sub 100. So.
Yeah, I always like the BS answer. Oh, it's a dry heat, but I still have yet to figure that one out. I think, wasn't it last year they did ISS to get back launched again, and they did it in July in Vegas. It was like 110 degrees when we landed. I'm like, this is insane. So, but anyway, Dan, you want to introduce yourself to our audience and give everybody an idea who and what you are, what you do?
Yeah, absolutely. Dan Kryzanowski, great to be with y'all. Two fun points. So, Ian, when I look behind you with the Braniff Airways, I was with part of my career with GE Capital Aviation Services, and that exact poster was in my desk when I was in Connecticut. So you're the second one in the world. I think we have I think there's an addition of two. And JB, I got to give you props for the intro, because 25 years ago today, I saw the Maryland flag. I was in Ocean City, Maryland, working at the Jolly Roger. So I full head
still there.
It's a tough putt when you're a kid, when you got to pay $80 for the full outfit before you get paid. But, I slung the captain's pizza, the 28-incher there. So I'm sure I bartered stuff back in my college days.
I'm familiar with that pizza, and I've lived there during college, and I'm familiar with a lot of it. All that stuff's still there. A little bit changed, but it's still the same thing. So great. So let's start with this, Dan. Just tell everybody maybe a little bit about yourself and about your company, where you got started, and we'll go from there.
Sure, absolutely. So, as I joked a little bit, grew up in the Northeast, grew up in Scranton. My parents were of that generation, the W-2, the pension. Probably should have read Rich Dad, Poor Dad a few decades back. Like many folks here, many of us Gen Xers and above, did the corporate thing. Life was moving and grooving until 2008. Then really had an inkling, and I had the benefit of having a taste of Austin before I feel the whole world came here. But the world was moving to, not just the long commute, not just the 60-40 stock bonds. And my light bulb moment was I was co-best man in a wedding, and I asked the guy what he did. He said he flipped houses. I'm like, that's cool. What does that mean? He said he makes 15%, or his investors do. Interesting. Thereafter, I said what he shared with me. He said, did you know you can use your retirement dollars? And for me, that was the light bulb moment. So this is going back a decade ago. And since I've been a passive investor, doing crowdfunding before the Jobs Act, having the benefit of talking to over 1,000 sponsors on the real estate and startup side, and then really learning, I'd say, some of the intricacies, such as a solo 401k. So with all that, I think what I'm known for, what I can share is, two hats. One, Rocket Dollar. It's a checkbook control, self-directed provider. And then secondly, and this is just coincidental, the shirt I wear today, I'm licensed Series 7 under BV Capital. So this is, I'd say, a variety of different commercial real estate opportunities for accredited investors.
Yeah, no, that I feel like everybody has an aha moment, especially in like the art, like when you go to all the REI groups and
Ian, I think you're frozen. I wasn't sure who froze, but it looks like it was Ian. Restart your computer, buddy. It's the other part about being frozen on a podcast is where your face ends up, right? Like, like what part of it froze. So let's dive in a little bit until Ian gets back on Rocket Dollar.
Sure.
Because I'm intrigued on that. Obviously, when did that company get founded?
Yeah, it got founded in March of 2018, and there's a few reasons behind that. You know, one of which Henry Oshida, previous founder of Honest Dollar, so it's where the dollar comes in, was acquired by Goldman Sachs. Quick fun fact: Henry and I we met at Money 2020, or I should say, met formally in Las Vegas. And I said, "Hey, Henry, I have a good self-storage deal. Did you know you can use your retirement dollars?" And of course, he already knew this and said, "Wouldn't it be great to have a very 21st century feel, tech-friendly, with all the bells and whistles of fintech, where somebody can sign up in 5 minutes, pay a flat price, and frankly, it's country club cool to tell your friends and your investors about a checkbook control self-directed account." So that was the advent. We purposely came out of the womb about 6 months early to take advantage of South by Southwest in Austin. And then fast forward 6 months, we were voted the top fintech startup in the world. Actually, I'll caveat that to second. We had to pitch in front of Shaquille O'Neal, and I guess Shaq doesn't need a self-directed IRA, but it really validated the point with the VCs and otherwise. And since it's been I think a very wise, slow and steady to really democratize that folks A, become aware, and B, become educated, and then have that ability at, hey, I have a quick 5 minutes to sign up, move money over, and then have that true checkbook control to do, frankly, what they're doing in their piggy bank checking account.
Yeah, and I know Ian and I are familiar with checkbook compared to a regular self-directed IRA, that you have a little bit less control. Let's just discuss that real quick. So what, let's say somebody's used to whatever, the bigger Pensco, Equity Trust, things like that. Like, what is some of the checkbook writing IRA places have, and what's an advantage of that? What, they have more control?
Yeah, and the biggest thing is, I think, timeliness and benefit, particularly if you want to, I'd say, get in on a good deal, get with the best of breed sponsor. The gentleman I referenced before, there's times it's, football Sunday. He's like, "Hey, do you have a random 32,000 to put in my deal?" And I can do that literally on the spot with online banking. I'm not going to, going to one of the legacy custodian guys, filling out their paperwork, having a back and forth. And then if I do have a unique question, not to knock, but there's a fair number of junior folks that are at some of these shops just for sake of filling out their paperwork, vis-a-vis, and I compliment Brendan Walsh, who authored our knowledge base, and HubSpot said, "Guys, this is dynamite. This is truly award-winning." So we've, from the benefit of education, I think that's another difference too.
Yeah, because I'll never forget, my business partner Chris and I spoke at an equity trust conference years ago, like early on when we were, we haven't raised capital in about 10 years for our lending company, because capital, lending company grows very, very quickly and more than deal flow. But early on, we were raising capital. That was our full-time job. And I'll never forget, a big takeaway that I had with that event is there are so many folks that are interested in self-directed IRAs. They have the capital, but all of a sudden, they put their capital somewhere, and then they don't know what's next. Then they don't know what deals to invest. They don't know what deals to invest in. Do you think that if someone's a little bit more of an active investor and like they're constantly doing deals all the time, that checkbook IRA is just kind of a no-brainer? Like, they almost have to do that, because if you go to and I know I keep bringing up Equity Trust, but like, that's just what a lot of people know that name, and it's not necessarily a good thing. But filling out a direction of investment is a pain in the neck, and like, the problem also is, like you said, the education. Like, you need someone that you can ask questions. Is this a prohibited transaction? Can I do this transaction? Because nobody knows. And as this, 10 or 15 years ago, it was a newer concept for a lot of people, but now it's mainstream. Like, every single person that's a real estate investor, for the most part, knows or has someone that has a self-directed IRA.
Yeah, I mean, at this point, a lot of folks, particularly if you're attending these shows in person, I think the net benefit, you're right, of COVID, it may have been something you thought of, but fast forward 2 years, if you're considering even being a passive investor, you're probably on at least 10 drip campaigns, have listened to 10 or 20 webinars, et cetera. So you're right. And the big difference, I think, is one, particularly if you're looking to test the waters, whether it's crowdfunding or otherwise, yeah, I mean, that's a good hour of your time you're losing every time you want to transact just for sake of moving your money. And then, like anything, there's probably a sponsor, I'm sure you see this on the notes side, that there's more of a cadence. It's every few months, or you're adding a tranche, and the story's out there. It's already, it's kind of ridiculous to have to go through very heavy amounts of paperwork for, frankly, the same sponsor, the same strategy, everything else. But that's what kind of pulls and bogs down. And then I think call it the cherry on top with some of the legacy folks is that, God forbid you make a good investment and double, your value, you're paying on an AUM basis versus on just a flat model.
Yep. But the retirement account in general is treated the same from a taxation standpoint, right? It's just really the vehicle to get the cash out of the account versus, right? Like, you're still potentially exposed to UBIT. You can't touch the money for X period of time, right? Like, it's still a self-directed IRA in the end. It's just, you have the checkbook writing capabilities, correct?
Yeah. So all the tax law, and great question, Ian, you're right. Let's say you're at your current job, a 401k, you move, you go to a Fidelity rollover IRA, you go to, as Jay mentioned, equity trust, and then you go to a rocket dollar. If it's all pre-tax traditional, according to the IRS, you just haven't paid taxes yet. If you pull the money out before you're 59 and a half, you'll pay an early withdrawal penalty. Everything else is the same. Now, the two things is, one, what you can invest in. So the first two stops on the train, you're really limited to a box. The next one is the last two boxes, which call it an equity trust versus a rocket dollar, is what you can do with your time. And that's, I think, the big, and also what you may be charged for it. That's a big difference, vis-a-vis the legacy custodians.
Yeah. I mean, the last deal that we raised capital for, where we did a big cap raise, it was a $12 million acquisition. We had some IRA investors in, and, obviously there was a lot of paperwork and checking boxes and dealing with it. And then I have another investor, a friend of ours out in Oregon. He's like, all right, yeah, I sent the money. We're all done. I said, isn't that your retirement account? He's like, no, I got a checkbook one. We're good. And it was done in like 2 seconds.
Exactly.
It was way easier to deal with than, the traditional ones, which is nice. Everything has its advantages and disadvantages. I think most people on our show know the benefits of self-directed IRAs, Roth IRAs, all that. I want to ask you more. Is there any case law coming up? Because I know sometimes I've heard some people talk about like coming after checkbook IRAs and all that kind of stuff. I know that last legislation that they were trying to push through that got killed. There was some stuff coming up. Is there any legislation that you see coming down the pike that we should be concerned with in the way of retirement accounts or be aware of?
Yeah, so I don't see anything. In rewinding about 9 months, what really surprised me, and I mean, personal politics aside, I didn't see from either side of the aisle political benefits to say, hey, we might put a kibosh on self-directed accounts. For many reasons, there was no political gain. And all even from culture wars, et cetera, didn't really play into any of these topics. So I was very surprised. And, I compliment my friends at Quest for, hands off my IRA. And it's funny, Nathan and I were on a panel at Family Office Club right when this news sort of hit to talk about it, which always makes things fun. And then separately, there's another gentleman, I think, took great liberties on a footnote to make it sound like SDIRAs were going to go kaput versus a solo 401k is the only option. I didn't see much legal basis behind it, but yeah, it had a little noise. So all said, I don't see anything. One, the current climate we're in, let's say, the three, President, House, Senate, nothing changes in a few months or in 2 years, which I do think there'll be some shifts if it's a DRR. I don't think, if nothing were to change, I don't really think things are going to come into law today. It's just not the environment to do that. And then on top of that, historically with the more, at least call it one of the three on the Republican side, if not more, it tends to be more, I think, business friendly. Social is a different thing, but in terms of the business side of your life, you do have that empowerment. So I think we're going to move back towards that. And, the final thing here is also with the stock market dropping and the heavy volatility, once again, there's no political points to gain to be like, we really think you should just be in a 60-40 stock bond limited to whatever, Fidelity offers you. This is not the time to kind of present that.
Yeah, no, good point. And I mean, listen, I mean, it plays a great purpose for response, for the responsible ones. And I feel like the non-responsible ones, and I think that's where the checkbook conflict is. You don't necessarily, maybe I'm wrong with this, but like, I have people that obviously self-deal, but they're not maliciously self-dealing. They do, they're doing it because they don't know on it. I mean, I'm very familiar with this because I've had self-directed IRAs and we've invested self-directed IRAs for 15 plus years. But like, I certainly understand that not everybody knows, right? And they set it up, and then all of a sudden it's like, yeah, I'm investing in this deal. And it's like, yeah, but that's personally benefiting you or your family member. You can't do that.
The nice thing that I think, and two things. One is the IRS tells what you cannot do, and I think the analogy is very similar to a health savings account. And even if you don't have an HSA, you're familiar to say, I have to go to the doctor, or my kid broke his arm. You swipe the HSA card, to say, hey, I'm going to buy a nice leather sofa. Well, that's kind of a tough cut. It doesn't really.
Right.
It might benefit you mentally, but at least by the law, it doesn't go there.
Yeah, health wise, it made me feel better. I got to lay on that sofa, and then I want to back aches.
Yeah,
like there's logic. You can go down that path for anything, though.
Yeah, I might not suggest it if you get a letter in the mail, but and similar in the 401k line, no life insurance, no collectibles, and the big one, as you said, is no self-dealing. And basically, what that means is not yourself or your linear family. So your company, if you're an executive, a person of control. Your kid's startup, you have to stay away from that. A beach house, we'll say Ocean City, Maryland, or we'll go up to Dewey Beach, and your parents stay there. You can't do that. And then to get in the weeds, even if you bought that Dewey house, you're not the one that's supposed to be changing the light bulb. You should have a third-party manager.
Well, and that's where some of like that law that was trying to come down the pike, not to go live in the past, but it's like they were trying to go after one man specifically, but he self-invested into his own company. If I understand the story right, Teal was putting money back into eBay and he was an owner. It's just like, how did that even pass the sniff test? And then you guys just let it, whatever. I guess that's more politics than anything, but there's just a lot of crazy stuff behind it that, I think too many people are affected by it that they knew they couldn't do something. Jay, I think we had John Heyer on right around, you probably know John, and he was really outspoken about it with that, all that as well, is that it's just like, there is a lot of gray area, and it's easy. Too many people, all of us, have been in that situation. Yeah, just this one time, and you can't legally do it. And I think too many people, when they have control, and maybe that's why people have fear, checkbook IRAs can get a bad rap, is that people are like, well, they have the freedom to do whatever they want, so it's harder for them to stay compliant, right? So.
Yeah, and this is where I think the education really comes into place because, as I said, you're right. Once ultimately at the end game, your checkbook control, it's much like parenting. There's certain extremes. I think if you guide your children one way, they're less likely to do something or to do something, say, publicly or with thought behind it. Same deal here. I mean, I feel with the webinars, the podcasts, the knowledge base. Having folks both on the sales team, fulfillment, and support that really, really know the stuff, as is at Rocket Dollar, that, somebody says, hey, can I invest in a cannabis company? No, you can't touch the plant, and here's why there hasn't been legislation. There's enough steering and guidance, and I'd say relatively, examples, we have the pretty little charts and such, that folks would know, like, yeah, I can't be the Peter Thiel for my own company and invest because I'm CEO. And if folks in the gray area, as I said, we just share facts back. And then, ultimately, a lot of times they either choose to not open the account because of, or say, yeah, you're right. Let me just invest in my buddy's company instead.
Well, one more question related to this, and then we'll move on a little bit. What's your opinion or thoughts related to co-owning a property between your personal name and your self-directed IRA? Because that's something that a lot of people think they're both things of that. So you have whatever $50,000. Self-directed IRA is $50,000, and you buy that property 50-50. Third-party management third party everything. Like you're not involved.
Mhm.
So you're not getting personally benefited. The only personal benefit is you potentially need an IRA to make the deal work. That's where I think the gray area is.
Yeah, so a little bit of breakup, JB, but my general guidance is to not commingle your retirement and you, um, even if it's a 50-50. So let's just say if you're in the business of this and you do short-term rentals, my thought, and I'll give a quick rule of guidance, at least what's shared with me, is that if you have 110% of the value, you can buy a house outright. So let's say Scranton, PA, where I'm from, where you can probably still buy a half decent house for 100K. You have 110,000 in your IRA or your solo 401k, you can buy the house outright. Let's say house B costs 250. Instead of, as our example here, say commingling, with your personal account, maybe you put 100K down, then you do a non-recourse loan for that remaining 150. And this, by you, I mean your solo K, and then your solo K does a non-recourse loan. And just if stuff hits the fan at the end of the day, the bank's only going after the property, not your other retirement assets, not you personally. So I would say, and like anything too, otherwise, just from a business decision, are you really stretching yourself if you're putting so much of your retirement and your personal into something? So even outside of the potential, I think it's not as much of a gray area, but I would also say just from a head to toe holistically, maybe not put all your eggs in one basket.
The gray area, or so the non-recourse loan option is, you're just doing a loan to the IRA. That's no problem. I get that. I do non-recourse loans as self-directed IRAs because I would rather have the extra collateral than the personal guarantee at the right numbers, right? I'll just lower my exposure. But I guess the question is, and this comes up a lot, and the reason I'm asking is because I've talked to a lot of people. I personally don't think they should commingle at all. That's my opinion. I think that it's gray area. But I've talked to a lot of people that think it's fine. I've certainly done deals for people that it's fine because they've talked to, they go to guru events and things like that. They're like, this is how you structure it. So like they'll say you have $50,000 in cash, forget the loan. You have $50,000 in cash, you have $50,000 in your self-directed IRA. You own the property 50-50. Don't commingle it. But that doesn't mean that they're not both owner. I think it's black area personally. I wouldn't do it. I like to ask that question to a lot of professionals because I don't think it is. And and a lot of people have said, yeah, there's an argument that it's kosher.
Yeah, no, I mean, to best of my knowledge, no. And I think some folks are either, A, they've been misguided, or B, they may have taken the punchline from a different scenario. For example, as an LP investor or with multiple folks, the LP investor is the most common. Then, you try to shift that logic to GP, and it's a different sort of world. The other time could also be like, my spouse and I are going in, and just a side note, a decent rule of thumb. Once again, your spouse is a disqualified person, so your linear family, it's kids, parents, grandparents. Oddly enough, brother and sister are not, but I do want to caveat, you never want to give your brother or sister a sweetheart deal vis-a-vis other LP investors if you're doing kind of a basic raise. With all the joking behind it, in-laws or mother-in-law is not, but still same sort of kind of fairness across all investors. Just a side point that I share, which I don't read as much, but if two IRAs are going in together into a multi-member, say LLC, the general rule of thumb, particularly say if it's husband and wife, is to be at 50-50. Or if it's three people that you're literally in the family, you want to be a third, and not just from an administrative side. I think in terms of, there's deeper reasoning for a different call why you would want to do that. So just an FYI, because I know a lot of folks say, well, I can go 90-10, but I said some people view that differently, meaning 90% of IRA person one, and then the spouse with only 10%. Going in the weeds here a little bit, but high level,
Makes sense.
Read your cases out there. They've been documented pretty well.
Yeah.
Yeah, no, that definitely all makes sense. And obviously, as you're getting into a deal, you want to consult a professional. That's why these guys are here before you do something stupid. They can't tell you what investments to buy, but they can definitely give you guidance. Does it pierce what you're supposed to be doing or not doing. With that being said, I mean, we could sit here and talk real technical stuff, but I don't think our audience some of the audience wants to hear it. Some of it needs to hear it, but more importantly, let's talk real deals. Like let's case study some stuff. I know you helped raise some capital. You guys had a 9-figure exit, if I remember correctly, on some storage deals. Like let's talk some case studies of how one can use their checkbook IRA to get into deals, and what does that look like, and kind of what you see across the board.
Yeah, absolutely. So, I mean, the nice thing, and for anybody that's raising capital out there, even if you're building, as Jason said a decade ago, building your investor base, I would strongly suggest this one sentence to share with your investors. Did you know you can use your retirement dollars to invest passively in my next deal, in this deal, in my past deal, et cetera? Folks that do this on a regular basis tend to get about 10 to 20% of their raise. So I joke, but not joke, and say you can take Friday off. And the big win happens to be when you get somebody that's really enamored, but let's say they have, for our East Coast friends, 3 kids at, I guess we can all pick on Princeton, some school like that that's expensive.
Right.
Me as a Penn guy here. But point being is that this might be their only source of capital that, they can invest in here. So sponsors that do that on a regular basis are doing, I think, a great service for themselves and then also their investors. And over time, because what you see, especially, you're a little more attached to your retirement dollars in an odd way than your current dollars. You can't touch your retirement. But what I've seen a decent amount, and I'm not exaggerating with an extra zero, is you might have somebody put $50K in deal 1 and then $500,000 in deal 2, because they see, or call it deal 3 or 4, how deal 1 plays out. With their retirement, it's like, wow, this is really good, and I see the benefit here. So, no surprise, I've been in the storage industry for over a decade. Initially through Sparefoot, had the great benefit to meet all the CXOs at the REITs down to the next top 100. Tremendous praise and thanks for folks across the board in the storage community. One gentleman, John Manus, I felt he was the top operator. He, first time we sat down, we nerded out on economic occupancy. I said, boy, he'd be a really great guy to get to know. So lo and behold, was one of his earliest investors, would share my story. Storage is kind of headline now. I kind of feel kind of how industrial will be in 5 years. It's in the top 5 list, but people don't know why. And then it's going to be like, oh, obviously you got to go with this. So anyways, with storage here, John, I think, being that he had the long experience as an operator, which I think was wise, as folks invested, they were seeing really good returns. And ultimately, in the world of storage, 10 is kind of the magic number of similar size properties where you're ripe for a portfolio sale. So long and short, over time, John, Pinnacle Storage Properties built up over 20 plus and sold, I think, 14-ish properties for 100 million plus to one of the REITs.
And yeah, that's a beautiful exit. And the nice thing is that, you were able to get in with a checkbook IRA, right? Or a self-directed IRA, and that was all retirement funds. I don't know. I've always lived for today, and maybe it's wrong, but I've always been big on cash flow, but it's always, I agree with you. I think it's crazy that many people say, well, I can't part with this 50 grand that's just like dying in my savings account, but you know what? I got $500,000 or $1 million, $100,000 in this retirement account. I'll risk it. It's almost like it's not real money to them.
Yeah.
Whereas actually it should be some of the most precious capital that you have. But good.
It's not. I mean, it's not liquid today with them.
Right.
They can't go out and spend it. They can't go buy something with it. That was when we learned about self-directed IRA investing in like 2007. I would say, that's what really catapulted to help us raise a lot of capital, because, like you said, we went out there and somebody, non-active real estate and business people, they don't necessarily have a lot of disposable investable capital. Because they're not actively looking for deals all the time. I'm not saying they don't have money in the market, but it's hard for them to pull out their wallet to invest hundreds of thousands of dollars, right? Like, they're going to start small. And like what you said, Dan, it's, hey, do you have, back then, nobody had self-directed IRAs. We had to educate them on taking them. And a lot of them couldn't do it because a lot of them were government workers in the DC area. But we learned the process and we helped them convert them. We did the paperwork, we did the heavy lifting, we learned how to do that with them. But all of a sudden it was like, well, I got 7 figures and I don't want to be in the stock market right now. And we're in a very similar space as what we're at right now, where people are nervous about being in the market. So I think it's a great time to go out and raise capital in this fashion. And there's a lot more education out there than there was before, and it's a lot more mainstream.
Yeah, absolutely. And so a lot of great points. Also I think in diversification. So Ian, you gave a very real example. I think it's going to be a discussion, I'll say sales call out with somebody later today, is they said, yeah, 50K, my savings, literally, it's earning 0.01%. I had another buddy in his wealth fund earning 1%. We at BV, one of our strategies is short-term loans that pays, anywhere from 15% on a nominal basis to, call it in the 20s. So probably similar to the best of breed stuff that, particularly Jason has seen on the note side. That's a great place, but then you still have 500,000 of your money that you don't want to sit stagnant. And another thing too, just kind of to shift the mindset, folks say, well, yeah, but it's a high yield dividend. I say, okay, let's step back. Stock was at 100. It's a 5% yield, or even call it 10. We'll give some liberties. But if it goes down, $12, like you're still in the red for the year. Right. Which from valuations for people that thought they were really accredited to not being accredited, it's a tough putt. Whereas in real estate, you have 100K, you invested. Generally speaking, that 100K really rarely goes down from a valuation. It stays flat effectively till the property is transacted. And most times, and not saying it doesn't go right all the time, but particularly on a value add, you're going to get your 100 back and at least a few other dollars and some cash flow in between. So in the spirit of compounding interest, this is where I do think you do have to take back control. You can't be in that kind of stagnant 60-40, because you're going to wake up in 60s and it's not really going to feel like that much money.
Yeah, we're all cultured. You're going to take me down a wormhole, but yeah, we're all cultured through school. I think we're all in the same age group that it was go to college, get a job, wait for your Social Security. You'll be fine. You'll have a few extra $100,000 in this bank account and you'll be fine. Right. Like I was a fireman for the city of Baltimore for the last 15 years. I recently left. And I see guys sitting, there was a guy yesterday who retired. The chief had 52 years on the job working for a pension that pension could be blown up tomorrow. I mean, we're talking about Baltimore City. We're not talking about, some beautiful, look at California, beautiful places up and down, great rich area. And they all went bankrupt in 2008, I don't know. I think that little purple book that everybody talks about, Rich Dad, Poor Dad, is like, that should be what you read in high school, and you should read it every year until you graduate, and you should read it every year thereafter, and just have a nice refresher, because too many people rely on what status quo is versus getting out there and doing and making your own path. You really have to. You have to secure your own retirement. If you count on what's promised to you, we don't know what's going to be. Look what's going on right now, not to make it political, but you got a government. We don't know which way is up right now. We got a stock market that only can see down right now. And everyone's relying. Think about it. If you're in your golden years and you're about to retire, right, and you're looking at all this, how could you ever contemplate retiring, seeing all this crazy stuff going on versus having, like you're saying, Dan, and me and Jason 100% agree with this, is having that nice flat trend line that maybe goes up to the right just a little bit, and you'll have a pop here and you'll have a pop there, but for the most part, we're nice level lines, and that's what we like, and that's why we invest in real estate. That's why Jason does hard money loans. It's consistent, it's not sexy, but it produces dividends, and that's what we all look for.
Slow and steady wins the race. The right way, though.
Yes.
The right way, not, hey, I just have to. Listen, that guy you're talking about, Ian, and so be it, but he was playing defense for 52 years. Literally not going out there and trying to win and play offense on a regular basis, because even playing offense, keep in mind, there's still cycles where you're taking a step back, but again, you do the right thing and you're 2 steps forward.
Yep.
Over and 100%. Over and over.
Another just a side thought, but I think it's important. Us Gen Xers tend to have kids a little bit later, and folks coming up and down. I think having your kids involved is important. And once again, this is where the self-directed IRA I think is important. Even from the standpoint of in good faith, if somebody has 10K, and listen, we all have different life experiences, etc., you can get a taste in a few different things in crowdfunding, which is really important. For most folks with a quasi-traditional, say if you're 40 and above, you probably have 6 figures that you could move into a self-directed account. The huge benefit here is I like to call the difference between like and trust. I mean, we can go on LinkedIn, Facebook, like a million things, but trust, frankly, is when money moves. And from a mutual perspective, I think a lot of wise sponsors will tend to let you in below the minimum, say carve out that last 100K for people that you want to get to know you. Why do I share that? The benefit here is, and not saying you're going to have your 5 or 6 year old literally wiring money, although I'm sure they can do it. They can hack into anything these days. But with my little guy turned 6, he's aware that, cool, here's what we invested in, and we got dividends, and dividends equals toys, and there's a budget too behind it. So I think some of the basics, but it's not here's a stock certificate and you get your little check in the mail and go this, and it seems like guaranteed. This is more as, hey, you see that storage building? Yeah, that's what we're doing. Where was Dad? Dad was in California. Oh, we're buying a hospital there. Okay, cool. So it's extremely tangible. And let's just say we wake up tomorrow and all the U.S. dollars has 3 zeros at the end for some inflation. There's still going to be those buildings and people are going to be paying that. So I think that's probably the shift, as Ian, you mentioned what we experienced during our school days.
So we have similar age kids, and I asked someone the other week on our show. Guy does $1 billion of loans for the company he works for. I think he founded it, and we got talking because his son's interning at Jason's office right now. Obviously, guy instilled great values in his son. But when do you? It's a 2-part question. One is like, when did you decide to start talking to your kids about how real estate works and what it does for you and your family? And then second part to that question is, anyone that's watching, what can they do for their kids, Kitty Ross or anything along those lines, to set up their kids for success in the future and maybe give them a nest egg?
The gentleman out west, we were introduced last year, and I thought I've heard it once, so I'd love to repeat it because I haven't heard it from anybody else. He said, screw the 529s. When my kid was born, I bought him a building, and he's going to college now. Or he's of college age, and he can choose what to do with that building.
That's beautiful.
So I'm feeling like a schmuck, SM, in case we're translating here. Transcribing. But okay, that's wow, what a great, or land, I would even say. It's almost, I remember I still have the savings bonds or whatever you'd get as a kid. I would argue now. And so, putting how to make it easy and how to also use your retirement, Carter and the friends at Acre Trader, I think it's dynamite. A peanut farm or an acorn farm, it's true. As Mark Twain says, there's land, there's not more of it. And these guys underwrite super conservatively. I'm bullish on that. So, even if, you do go down, if there's certain side of structures, for your kids, think of stuff like land. Think of things that, regardless of how much money's printed, that will still have some, ratio value to whatever happens to be our paper currency.
Yeah, I asked selfishly because that's why we do this podcast, so we can talk to all the experts. Is that me and Jason have been talking. Jason and I, sorry, I got the worst English in the world. Not my strong suit. Math's just a little bit better. But is that I've been going back and forth about opening, and I think I'm kind of committed to it. Is just a whole term life insurance policy for my kids, and setting that up, kind of like the Nelson Nash way of infinite banking and just taking it down that road, because there's so many choices out there. I know Jason's big on the 529, and there's a bunch of ways to do this. And it's like, you got to pick one and just go with it. And once you have the success, that's when you can start to branch out.
Well, I'm big on buckets, right?
Yeah.
I'm big on set it and forget it. Like that 529 doesn't do much. And I'm only getting the write-off on the Maryland side anyways. So like there's not a ton, but to me, like, I'm all about buckets, right? Buy a property, it covers this. I buy this, I do this. This auto comes out of my account. Like, that's always been kind of early on in my investing career was cool. Well, hey, we need an employee, or we need this employee. I don't want to take money out of my pocket. My partner doesn't want to take money out of our pocket. How are we going to do this? Right? And cool. Well, this will cover this, and this will cover that. So that's that's one of my. I like the idea of buying an asset, like a real asset, like a building for a kid. One of our capital investors that I'm good friends with, he did that. And he does that for his kids as well. knowing that, I don't really care what this thing's going to do over the next, few years. I know in 20 years that's what's important. And it was in a good area that, hey, the kid can live in it. He can get rental income from it. He could sell it. And hey, he gets to reap the benefits for the first 20 years until it goes to the kid.
Yep. 100%. Well, Jason just has too much active income. I just want to put that out there. If you pay taxes, you need more real estate in your life. I just want to let
that's the only downfall of owning a lending company is interest. Interest income's a freaking killer the way it's taxed.
Slowly but surely getting them into more deals. But anyway, yeah. So before we roll out here, I mean, this has been super informative. I don't know if we have any questions over here. We do have 2 questions that we ask everyone. But before we do that, is there anything else that you want to leave anyone with on, self-directed IRAs, on, just thoughts or anything that, like, if there's one takeaway that they could take from this episode about self-directed IRA, what should it be?
Yeah, I would say to be aware and to learn a little bit more. So rocketdollar.com/learn. We purposely spent a good year, and all of us had these accounts already, to really verify things, put it together, which I think is a good way. And then from there, however you use it, whether it's for personal or your capital raising, and like anything you would do, whether it's your feel called for a checkbook side or a traditional custodian, have a few of those relationships, especially if you're a sponsor, because your investors are all wired differently, and some want checkbook, some want the custodial relationship.
Nice. What's we like to end with this question. What's one good book or podcast that you're listening to, reading, watching currently, just called in the last few months that you really enjoy?
Yeah, and I'm going to put the and I wish my arm was 20 feet long so I'd be able to grab my books from it. But I'm going to be political and give you 3 answers because I think they're good.
We'll take 3.
The first 2 come together. So the first is Ray Dalio. I think it's Changing World Order. It's his newest book. Yep. It's through cycles over the past 500 years, including China, 1,000+ years behind it. In short, the U.S. Vis-a-vis the rest of the world, we're kind of in the 5th of 6 stages, and China's on the upward. And the 6th can either be a soft landing or a not so nice, to the extent that, the physical dollar is worth nothing. We wake up one day. That's one. Second one, Friedman, New York Times author, The Storm Before the Calm. That's the title. That's purposely why. And basically, the quick behind it is we've had 80-year cycles of major events. Became a country, Civil War, World War II, whatever is going on now. Similar, there's a 50-year economic cycle in the U.S., which, regardless of whoever was there in the late 70s, happened to be Jimmy Carter, much like if Biden gets reelected or whoever comes in 2024, will look like, the not so smart guy in history. It's just the economic cycle that comes through. So I think both of those gives you a good read, and in some way, kind of a comfort level of like, wow, this is pretty intense what's going on. And the other one is Meg Hogue. She's local here. She's a member of my Vistage community. I actually saw her speak this morning again. I read her book, and boy, I wish I remember the title. But, in short, it's, to realize that we're not thinking beings that feel, we're feeling beings that try to think but don't do so well. And basically, here's a way to get, whether it's personal work, etc., those reptilian habits, how to catch yourself doing it, and then just, as they say, in a way, let your ego go, but also how to process, in kind of the work-life balance. It's POAG. Look her up. It's a dynamite one. So that's great.
Literally trying to look at it now. I do the adversity hack. Is that her?
Yeah, there it is. Thank you.
Yeah. I definitely like the quantum physics universe type stuff. I thought Happy Pocket Full of Money is a really good one. That same thing about manifesting and getting your mind and shifting. Because again, going back to high school, what they teach us, they should have spent more time talking about manifesting your goals and being successful for what you want to be successful for. So, but Dan, we definitely appreciate having you on. What's the best way to get a hold of everyone to get a hold of you? I know you said rocketdollar.com. What's the best way people could reach out to you if they have any more questions?
Yeah, so I'm pretty big on LinkedIn. Obviously, there's not too many Dan Kryzanowskis out there, so you'll find me pretty easy. Say that you heard it with JB and Ian. Secondly, I also like to give a thank you. So I joke, if you can spell it, you can get it. D Kryzanowski, 12 letters. That'll get you some change off a Rocket Dollar account. And if you should happen to also be a sponsor, reach out to me. We'll see what we can do to have a deeper conversation. Separately, in terms of it seems like the world's moving to Texas or has an interest on the investing side. So once Wilson's under VD Capital, we're in a mix of value-added development, multifamily, industrial, and even getting into some opportunistic bridge and DSTs. If any of that is a slight interest, and I put my money, on the stuff that I represent. So my portfolio is, a cap table of 20 plus LP investments, and I'm pretty open in a one-on-one conversation to share what I have.
Oh yeah, man, we appreciate that. So definitely appreciate you having you. This episode was powerful as always. Again, guys, if you got any value out of this, please, share this. This is life-changing stuff for everybody, whether you're in high school or you're about to retire. The time is always now. So Dan, we appreciate having you on, and I'm Ian from Equity Warehouse. That's Jason from Harmony Bankers. What you got, Jay, before we roll out?
Nothing. You did it. You guys ended it.
I'm in the groove today, man. It's been a while since we've done a live episode like this, and I just, usually when we're in person, I just kind of sit there. There's so much stuff going on. But here I am. I get to be free.
You like to have fun. Keep that smile going.
Yeah. So,
all right, Dan. Appreciate it. Thanks.
Take care.
Thanks for tuning in to the Real Estate Reserve podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time,